What is up, guys? Today I'm going to be talking about a legal way to make your mortgage tax deductible just by using rental income. Sounds too good to be true, right? But it's not. This strategy can save you thousands in taxes over time, and the crazy part, most people have never even heard about it. And even the few that have are using it incorrectly. So if you're a rental property owner or planning to become one, today I'm going to be breaking down a strategy called rental cash damming. What it is, how it works, and how it's used to make your mortgage work for you. If you already own a rental property, or even if just planning on buying one in the near future, this strategy could be a total game changer. Now, this is not some loophole or gray area tactic. This is fully CRA compliant when set up properly. And it's used by savvy investors to build wealth faster while paying less taxes. Let's face it, in Canada, most of us are paying down mortgages with after-tax dollars, and we get no tax break on the interest for our principal residence. But what if we could change that? What if we just moved our money in a different way to generate tax refunds to further pay off our mortgage? Simply put, it lets you take your rental income and use it to convert your personal mortgage, which is normally non-deductible, into deductible debt. This is like something called the Smith maneuver, which is about converting your mortgage into tax-deductible debt, but instead of buying stocks or mutual funds, in rental cash damming, you're reinvesting those funds into your rental property expenses. It's more straightforward and often more accessible for landlords who already have rental income flowing in every month. I'm going to go over how it works in a bit of a nutshell. So, number one, you're going to collect that rental income, whether it's cash, check, e-transfer. You're going to use that income to pay down the principal mortgage on your primary residence. This is going to have a readvanceable line of credit or HELOC attached to it. So as you pay down that principal, the same amount becomes available to borrow again through that line of credit. You then borrow that amount back and use it to cover your rental expenses. So since you're borrowing to earn income, the interest on that borrowed amount now becomes tax deductible. So let's go through a basic example. Let's say you bring in $2,500 a month from your rental property. Instead of using that money to directly pay the rental bills and expenses, you deposit it into a dedicated rental income account. I recommend keeping that account separate for clean tracking purposes. From there, you use that $2,500 to pay down your primary residence mortgage, which has that line of credit attached to it. Once that payment clears, your line of credit limit will increase by that $2,500. Then, because you're borrowing that money for income generating purposes, the CRA allows you to deduct the interest on that borrowed $2,500. Now you repeat this every month, and slowly your non-deductible debt becomes deductible, and you're building a nice tax refund along the way. Now there's probably a few questions that have already come up along the way. Stuff I hear all the time, like this sounds illegal or like a loophole, which is not true. The CRA doesn't care where borrowed money comes from. The only thing they care about is how it's used. So if you borrow money and use it for your rental, it's deductible, plain and simple. Another one I hear is my accountant has never mentioned this. And unfortunately, many accountants don't proactively bring this up because it's more of a strategic setup and not all clients are ready for it. But structured correctly, it is a powerful tool. Another last one that I hear all the time, this is only for rich or big investors, which is also false. If you have one rental property and a mortgage, you can use this. The setup is complex and must be done right, but people like myself do this on a daily and spend a lot of time with our clients, making sure they understand how it all works. So this is important. There are some rules that you need to follow. Number one is you must keep clear and separate records when you're using this structure. If you mix personal and business funds, the CRA will deny your deductions. Number two, you need the right type of mortgage. Not all the banks offer the readvanceable products, So you may need to refinance or switch into those products that work for this structure. And the third one, you cannot use borrowed money for personal stuff. So if you do, the CRA can deny all deductions related to that portion. That's why working with a professional who understands this structure is key. One bad setup and the whole thing could fall apart. All right, so I'm going to pull up this real live scenario on this calculator that we use to generate these numbers for our clients. And I can show you where the numbers are going and how it's all calculated. So this scenario, this client has $600,000 left on their mortgage, 4.45% interest rate, 20 years left on it. Their mortgage monthly payment is $3,766. They're making this payment just like they regularly would be on that primary residence. Now, this mortgage has the line of credit that's attached to it. Right here, this is what you're going to be funneling that rental income through. Their rental property is worth $400,000. Their mortgage balance is $300,000, 4.45% interest rate, 20 years left on that one as well. Their mortgage monthly payment is $1,883, including your maintenance insurance, condo fees, management fees if there are any, and property taxes. So the total monthly expenses on this file, $2,358. Now, the rental income they're receiving is $2,500 a month. So by routing that $2,500 through that readvanceable mortgage, paying it down into that primary residence, and then borrowing it from that line of credit to cover the rental costs, they're reducing their mortgage by 17 years instead of that 20 years. So that's where that is. It's going to show you over here. 17 years is when you're going to pay it off. That's a total tax refunds of $86,977 over that 17 years. Number of payments reduced, that's 36. Those are payments you would have had to make, equaling to $135,596 of future payment savings, which will come to $251,105 of pre-income tax savings. Because you pay your mortgage with after-tax dollars, this is the amount you would have had to make to pay that mortgage off. You're saving this amount that you don't have to make anymore. You can put that money in your pocket or invest elsewhere. This breaks this down into a little bit better ways so you can kind of see what's going on, where the numbers are going, how it's being generated. And yeah. So there you have it. Rental cash damming. This is that strategy that is good for smart landlords to use legally, producing tax refunds to further pay down that debt and increase their rental return on their investments. So if you're curious about whether this strategy would work for your situation, drop a comment below or reach out, book a free consultation. If you found this video helpful, hit the like button, subscribe for more mortgage and wealth building strategies, and share it with a landlord friend who you think could use this info.